Welcome to the weekly market recap with SC Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. In a recent development, the Central Bank of Sri Lanka is collaborating with commercial banks to reduce the country's elevated net interest margins, currently standing above 4%. Central Bank Governor Dr. Nandalal Veerasinghe said the margins have remained high mainly due to heavy taxes and a large volume of non-performing loans in the sector. He explained that during the crisis period, banks experienced margin compression, but profitability rebounded in 2024 as institutions reversed some provisions made for debt restructuring. However, the governor noted that profitability levels are now gradually easing, though they still remain stronger compared to the past several years. According to central bank data, the banking sector recorded a profit after tax of 187.5 billion rupees in the first half of this year, a sharp 67.8% increase from 111.8 billion rupees during the same period in 2024. Dr. Veerasinghe expressed hope that as economic stability improves and Stage 3 loans decline, net interest margins will reduce further. He said the historical average has been around 3.5%, but it currently remains about 0.5% higher. He also added that the central bank's Financial Consumer Relations Department is preparing new regulations to enhance disclosure, transparency and competition among banks, all aimed at narrowing the net interest margin over time. The Central Bank of Sri Lanka says the government's fiscal performance is now exceeding expectations, marking the first time in decades that fiscal targets are likely to be surpassed. Central Bank Governor Dr. Nandalal Veerasinghe said stronger revenue collection and tighter spending have led to a lower fiscal deficit, describing it as a rare display of fiscal discipline that has improved the country's debt dynamics. Speaking at the presentation of the Central Bank's Financial Stability Review 2025, the governor noted that both revenue and the primary surplus are performing better than projected. According to him, revenue as a share of GDP will exceed the 15.3% target, while the primary surplus, initially estimated at 2.3%, is also expected to come in higher. Expenditure, meanwhile, remains broadly in line with projections, contributing to a smaller than expected deficit. On credit conditions, Dr. Veerasinghe said that although private sector credit remained below pre-crisis levels, it is gradually strengthening alongside the ongoing economic recovery. He pointed out that the share of public sector credit is declining, creating more room for private lending, a trend he described as healthy and sustainable. He dismissed concerns about systematic risks in the credit market, explaining that the widening credit gap simply reflects a rebalancing of credit flows rather than any instability. Dr. Veerasinghe said financial intermediation is still below past levels, but the recovery is steady. He also reaffirmed that inflation is expected to stabilize at around 5% by next year, with the economy now growing at about 5% and projected to maintain growth between 4 and 5% in the coming year. The governor attributed part of the strong revenue performance to a temporary increase in vehicle imports following the relaxation of import restrictions. Commenting on the financial system, he said banks' margin trading exposure remains small, though margin loans have grown from 14 billion rupees in January to 60 billion by the end of August. Finance companies, he noted, continue to focus mainly on vehicle leasing, with mortgage-backed lending still limited. Dr. Veerasinghe added that the central bank is working closely with banks to reduce intermediation costs and net interest margins through greater transparency, competition and better asset quality. He said net interest margins remain above 4% but are expected to narrow as financial conditions stabilize. He concluded that overall macroeconomic and financial stability is improving steadily and emphasized the importance of maintaining fiscal discipline and confidence in the financial system to sustain these gains. According to the Central Bank of Sri Lanka, margin loans issued by local banks have increased sharply this year. rising from 48 billion rupees in January to 60 billion rupees by August 2025. Director of the Central Bank's Macroprudential Surveillance Department said that this represents a growth of around 25% within 8 months. However, CBSL noted that exposure to margin lending remains relatively small compared to the total banking sector credit. He added that margin credit is also provided by other market intermediaries outside the banking system. The central bank's financial stability review highlights that the rise in the marginal lending comes alongside a strong recovery in Sri Lanka's economy and stock market performance, following the recent currency crisis. The report said volatility in the Colombo stock exchange increased during the first 8 months of 2025 compared to the last year. It explained that both the all-share price index and the S&P SL20 index recorded their highest volatility since April 2022, particularly in January 2025, a period marked by sharp gains early in the month followed by bearish sentiment later on. The central bank said it continues to closely monitor domestic credit conditions, foreign currency exposures and liquidity developments to safeguard financial stability and help investors better assess potential risks. Sri Lanka is preparing to introduce a new, transparent and rules-based tax framework aimed at attracting large-scale foreign investments. According to the Board of Investment Chairman, the new system, developed in consultation with the International Monetary Fund, will apply to projects worth over $50 million. He explained that the initiative is part of the ongoing efforts to restore investor confidence after the suspension of long-term tax holidays that once extended up to 20 years under the Strategic Development Project Act. These holidays were paused as part of Sri Lanka's commitments under its IMF-supported reform program due to concerns about arbitrary and negotiated tax arrangements. The BOI chairman said the new framework will soon be formally announced. Projects exceeding the $50 million threshold will qualify for strategic development project concessions, with higher thresholds receiving more attractive incentives. He expressed confidence that this approach will make Sri Lanka a more competitive destination for international investors. Currently, Sri Lanka's corporate income tax rate stands at 30%, higher than several East Asian economies such as Vietnam and Cambodia, where rates hover around 20%. These countries also benefit from great monetary stability, which help maintain predictable tax and investment conditions. Unlike nations with stable monetary systems, Sri Lanka has historically faced repeated tax increases during balance of payment crises triggered by inflationary policies. The new framework aims to move the country away from such instability, ensuring consistency and fairness in investment taxation. The initiative aligns with global trends as major economies, including the United States, have discouraged prolonged tax holidays and advocated for a minimum corporate tax rate of 15% to promote fair competition. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.52%, the 182-day T-bill rate stands at 7.89%, and the 1-year T-bill rate stands at 8.02%, showing no change compared to the previous week. Thank you for watching. We'll be back next week.